Simon, on China, you say that the phase-in period is disappointing for assets like the yuan. Surely it's also going to open up more risks as well, as the bond market in China has been relatively insulated, and now it could essentially follow some of the vacillations of what's going on internationally.
Yeah, that's right. So I think market consensus had been that the phase-in period would have only lasted around 18 months. And so the kind of flows equivalent of that would have been about 0.6% of GDP annualized, so really substantially positive for the yuan had it been that quick. So the 36-month duration cuts that in half in terms of the rate of change. So, yeah, it's a little bit disappointing, I think, for the Chinese yuan. I suppose the good news is that ultimately those flows will come. And as I think you had earlier on the show, that amounts to about 150, 160 billion US dollars worth of flows over that 36 months.
Simon, let's talk about Malaysia. Was it a surprise that Malaysia was dropped from the exclusion watch list?
Definitely a few investors had expected them to remain on the watch list. So in that respect, it's a slight positive surprise. What I would say, though, is that positive impact might be mitigated by the fact that Malaysia's already enjoyed pretty strong inflows since we've seen the recovery from the COVID shock. So if we look at the 12-month rolling inflows, for example, into Malaysia, those have been about one standard deviation above the 5-year average. If you compare that with Thailand and Indonesia, they've been negative 0.7 standard deviations from that average. So to some degree, even though it's positive, some of those kind of flows have already occurred, if you like, or some of the positive news is in the price.